An emergency fund is non-negotiable. Let's get that out of the way first. But a bloated checking balance? That is a financial disaster waiting to happen. If you have $50,000 parked in a standard checking account earning 0.07%, you aren't being safe. You are being slowly robbed. Inflation is quietly charging you an invisible tax every single year. With even moderate inflation, that $50,000 loses around $1,500 of spending power annually. Over a decade, that is well over $10,000 of value gone, vaporized. The fix isn't to scrap your safety net, it is to right-size it. Keep 3 to 6 months of expenses liquid, and then put the rest to work. Otherwise, your emergency fund stops being a shield and starts being an anchor dragging you down. I see this all the time. I call it the safety paradox. You work hard, you save cash, and you see that big round number in your checking account. It feels good. It feels responsible. You sleep better at night knowing you can write a check for almost anything that goes wrong. But there is a difference between feeling safe and actually being wealthy. Today, we are going to audit that cash pile. We are going to look at the math that banks hope you ignore. And we are going to figure out exactly how much cash is too much. Before we dive into the numbers, do me a favour. If you want to stop bleeding purchasing power and start actually keeping the money you earn, subscribe to the channel. It's the best return on investment you'll get for $0. Now, let's look at why your bank account is lying to you. Let's start with the myth, or rather, the feeling. Cash feels real. When you look at an investment portfolio, the numbers wiggle. They go up, they go down, they flash red and green. It requires a certain amount of stomach to watch. But a checking account? That balance is solid as a rock. If you put $50,000 in there in 2020, it still says $50,000 today. That stability creates a powerful psychological illusion. We equate unchanging nominal value with safety. It is the mattress stuffing instinct. We think that if the number hasn't gone down, we haven't lost anything. This is the primary reason smart people hoard cash. It isn't because they are stupid, it is because they are human. We prioritize the avoidance of visible loss over the reality of invisible loss. Here is the reality check. I pulled the FDIC data on interest checking accounts recently. The national average rate is roughly 0.07%. Let's do the math on that. On $50,000, a 0.07% yield pays you $35 a year. $35. That is not an investment return. That is barely enough to buy a decent lunch once a year. Banks rely on this. They rely on you leaving that money dormant because they turn around and lend it out at 7, 8, or 9%. The gap between what they pay you and what they earn is their profit margin. When you leave excessive cash in a checking account, you are effectively giving the bank an interest-free loan. You are the venture capitalist funding their business model, and your return on equity is $35. But the low interest rate isn't even the worst part. The worst part is that while your money sits there earning nothing, the cost of living is sprinting ahead. This is where the unchanging number betrays you. If inflation is running at 3%, which is a moderate historical average, everything you buy is getting 3% more expensive every year. So, to buy the same amount of goods next year, you would need $51,500. But you only have $50,000, plus that sad little $35 interest payment. You have effectively gone backward. You didn't lose dollar bills, but you lost buying power. It's like someone sneaked into your vault and snipped the corners off every bill. The paper is still there, but it buys less. So, what is the protocol here? The first step is acknowledging that doing nothing is an active choice. There is no neutral gear in finance. You are either compounding forward or you are compounding backward. There is no standing still. Once you accept that leaving $50,000 in a checking account is actually an active decision to lose money, the paralysis breaks. We need to shift your mindset from storage to deployment. Money needs a job. Even your emergency money needs a job. Its job is protection, yes, but it shouldn't be sleeping on the job. In the next section, I'm going to show you exactly how much that sleep is costing you over a 10-year timeline, and the numbers are ugly. You might be thinking, okay, Tom, I lose a few $100 a year to inflation. I can live with that for the peace of mind. I get it. A small fee for safety seems reasonable. But you aren't losing a few $100. You are misunderstanding how compound interest works in reverse. If you think the annual loss is manageable, wait until you see the 10-year aggregate. We are talking about the price of a brand new car vanishing from your savings simply because you didn't click a button. Let's look at the 10-year horror story. Let's run a simulation. You have $50,000. You leave it in that checking account for 10 years. Let's assume a standard inflation rate of 3%. Again, that is not hyperinflation. That is just normal economic friction. In year 1, your real value drops to about $48,500. In year 2, it drops again. Compounding works both ways. When you lose value, and then lose value on the remaining value, the curve steepens downward. After 10 years of 3% inflation, that $50,000 has the purchasing power of roughly $37,000 in today's money. You have lost $13,000 of value. $13,000. That is a decent used car. That is a fantastic vacation. That is a kitchen renovation. Gone. Now, let's be a little more pessimistic. We have seen recently that inflation can spike to 4 or 5%. If we average 5% inflation over a decade, which isn't impossible given current global debt levels, the math gets violent. At 5% inflation, your $50,000 shrinks to about $30,000 in real purchasing power after 10 years. You have lost 40% of your wealth. 40%. Imagine walking up to an ATM, checking your balance, and seeing $20,000 missing. You would call the police. You would scream at the bank manager. But because inflation happens slowly, at the grocery store and the gas pump, you don't call the police. You just complain that things are expensive. This is the inflation tax. It is silent, it is automatic, and it is absolutely devastating to cash hoarders. Why do we let this happen? Behavioral economists call this money illusion. We focus on the nominal amount, the number printed on the bill, rather than the real amount, what the bill buys. It is a hard cognitive bias to break. It feels safer to have $50,000 that buys less than to have $48,000 that buys more. We are wired to avoid the pain of seeing a balance drop, even if a balance that stays flat is actually worse for us mathematically. It is the same reason people stay in bad jobs. The devil you know feels safer than the uncertainty of the market. But in finance, the devil you know, inflation, is guaranteed to kill you. The market might hurt you, but inflation will definitely hurt you. So, the protocol here is to stop viewing cash as safe. Cash is not a safe asset, it is a decaying asset. It is like holding a block of ice. It is solid right now, but if you hold it for 10 years, you are going to be left with a puddle. You need to view your emergency fund not as a wealth store, but as an insurance policy. You pay a premium, the lost returns, to have liquidity. But you don't buy 10 times more insurance than you need, right? You don't insure your house for 10 times its value. So why are you holding 10 times more cash than you need for emergencies? We need to calculate the actual insurance requirement. This brings us to the most common mistake. People say, okay, Tom, I need an emergency fund of 6 months. And then they calculate that number based on their current spending. They include the Netflix subscription, the fancy dinners, the new clothes. That is wrong. If you lose your job, Are you really going to keep spending $500 a month on dining out? Probably not. If you calculate your emergency fund based on your luxury life, you are over-insuring. Let me show you how to calculate the survival number so you can free up that trapped cash. To right-size the fund, we need your survival number. This isn't your current monthly budget. This is the bare bones, keep the lights on budget. We are talking mortgage or rent, utilities, food, groceries, not restaurants, insurance premiums, and minimum debt payments. That's it. No travel fund, no entertainment budget, no upgrading the wardrobe. When you are in a true emergency, you cut the fat immediately. So why would you hold cash to cover the fat? If your normal spending is $5,000 a month, your survival spending might only be $3,000. That difference is massive. If you are saving 6 months of expenses, the difference between a $5,000 burn rate and a $3,000 burn rate is $12,000 of cash that you don't actually need to hoard. Now, the multiplier. How many months do you actually need? The standard advice says 3 to 6 months. But let's get granular. If you are in a dual income household with stable jobs, think nursing, government work, teaching, 3 months of survival expenses is usually plenty. You have 2 income streams. The odds of both drying up simultaneously are low. If you are single income, or you work in a volatile field like tech sales or freelance, you bump that to 6 months. Only go to 9 or 12 months if you are self-employed with high overhead or highly irregular income. Most people default to the higher number just to be safe, but again, that safety has a price tag. If you are a dual income couple holding 12 months of expenses, you are likely holding $40,000 too much. Here is the psychological trap. We hoard 12 months of expenses because we are afraid of the what if. What if the roof caves in? What if the car explodes? But here is the thing. True emergencies are rare, and catastrophic, life-altering emergencies are even rarer. You are preparing for a 100-year storm every single day. The opportunity cost of that preparation is the wealth you aren't building. If you have that extra $20,000 invested, it could double over a decade. If you keep it in cash, just in case, it halves in value over 2 decades. Paradoxically, by trying to be too safe today, you are making your future self poorer and less safe. So do the math right now. Grab a napkin. Write down your survival monthly cost. Be honest, strip it down. Multiply that by 3 if you are stable, dual income, or 6 if you are single, variable. That is your target. If your survival number is $3,000 and you need 6 months, your number is $18,000. If you have $50,000 in your checking account, you have a $32,000 surplus. That $32,000 isn't an emergency fund, it is a laziness fund. It is money that you haven't assigned a job to yet. And as we established, money without a job gets eaten by inflation. Now the question is, where do we put the $18,000 and where do we put the $32,000? Before you take that surplus and dump it all into the stock market, stop. There is a middle ground that most people miss. They think money is either liquid in checking or illiquid in a retirement account. That is a false binary. There is a sweet spot where your money is liquid enough to access in 24 hours, but still earns 10, 20, or 50 times more interest than your checking account. This is how we stop the bleeding without locking away the key. Let's talk about the tiered defense strategy. The first tier is your checking account. This is for immediate cash flow. You do not need 3 months of expenses here. You need about 1 month of expenses, plus maybe a small buffer of $1,000, so you don't accidentally overdraft. That is it. This money earns 0% or 0.07%, which is basically zero. We accept that loss because we need the convenience of debit cards and auto pay. but not a penny more than necessary should live here. If your monthly spend is $4,000, keep $5,000 in checking. Anything above that is wasted potential. This is your operating capital, not your savings. Tier 2 is where the rest of that survival number goes, the remaining 3 to 5 months of expenses. This needs to move to a high-yield savings account, HYSA, or a money market fund. In a normal rate environment, these accounts pay 3, 4, or even 5%. Let's look at the difference. On $20,000, checking pays you $14 a year. And HYSA at 4% pays you $800 a year. That is free money. It is the same liquidity, you can transfer it back to checking in one business day, but you are getting paid to wait. There is literally no downside to this other than the 10 minutes it takes to open the account. If you are leaving your emergency fund in a traditional bank checking account, you are effectively lighting $800 a year on fire. Now, what about that $32,000 surplus we identified earlier? The money above your emergency needs? That is Tier 3. That needs to be invested. This could be a brokerage account, an IRA, or a broad market index fund. Over the long term, the stock market has historically returned 7 to 10% annually, nominal. If we take that $32,000 and invest it at 7%, in 10 years it becomes roughly $63,000. If we left it in checking, it stays $32,000 and loses purchasing power. The gap between those two outcomes, $63,000 versus $32,000, is your opportunity cost. You are paying $30,000 in lost future wealth for the privilege of staring at a static number in your bank app. That is an incredibly expensive subscription fee. I know the friction. Opening new accounts is annoying. Remembering passwords is annoying. But we are talking about thousands of dollars here. If I told you there was a pile of cash in your backyard, you would grab a shovel. This is the same thing. Set up the HYSA, link it to your checking, move the bulk of your emergency fund there. Then take the surplus and set up an automatic transfer to your investment accounts. Even if you just drip feed it in over 6 months, dollar cost averaging, get it out of the dead zone. Automate it so you don't have to use willpower every month. Once the system is built, it runs itself. Let's address the final mental hurdle. You might do all this math, agree with me, and still feel a knot in your stomach when you transfer that money out of checking. That is the scarcity mindset. We feel that once money leaves checking, it is gone. You need to reframe that. The money isn't gone, it has just been promoted. It graduated from being a lazy slacker on the couch to a productive worker in the economy. You are the CEO of your money. A good CEO doesn't let employees sleep in the break room all day. They put them to work. You have to trust the math over the emotion. The emotion says hoard. The math says deploy. Remember, liquidity is a spectrum. Cash in your pocket is instant. Checking is instant. HYSA is 1 day. Brokerage stocks are 2 days, settlement. Real estate is months. You only need instant liquidity for instant problems. A flat tire? Instant. A layoff? You have weeks or months to figure that out. You don't need $50,000 for a flat tire. By matching the liquidity of your assets to the urgency of your problems, you maximize efficiency. You keep the flat tire money in checking. You keep the layoff money in savings. You keep the retirement money in investments. This is asset liability matching, and it is how banks manage their own money. You should do the same. Think about future you. 10 years from now, future you is going to look back at this moment. If you leave that money in checking, future you is going to be frustrated that 30% of their purchasing power evaporated for no reason. If you optimize this today, future you is going to have an extra $30,000 or $40,000 in net worth. That is a massive gift you can give to yourself for about 1 hour of administrative work today. Don't let present you's laziness rob future you's wealth. The safety of checking is an illusion. The safety of a growing portfolio is real. I'll leave you with this image. Imagine you are on a boat. That's your financial life. An emergency fund is supposed to be a life raft. It sits there, ready to be deployed if the ship sinks. But if your life raft is made of solid lead, if it's $50,000 of heavy, uninvested cash, it isn't a raft anymore. It's an anchor. It's dragging the speed of your boat down. You are trying to sail toward financial independence, but you have this massive weight of dead capital slowing you down. Cut the anchor. Keep a lightweight, inflatable raft, your 3 to 6 months in HYSA, and let the ship sail at full speed. I want to hear from you in the comments. Be honest. What is your sleep at night number? Is it 10,000? 50,000? Does having a lower balance actually give you anxiety, even if the math says you are fine? I read every comment because the psychology of this is fascinating. If you found value in this audit, hit the like button so the algorithm knows we care about financial literacy, not just financial hype. And if you haven't subscribed yet, now is the time. We have a lot more myths to bust. I'm Tom, this is Tom Talks Money, and I'll see you in the next one.